Welcome to the Smarter Money Life podcast powered by Forum Credit Union, your go-to podcast for all things personal finance, where we break down complex financial concepts into simple, actionable steps. Whether you're looking to save more, invest wisely, or plan for your future, we've got you covered. Join us each episode as we bring you expert insights, real-life stories, and practical tips to help you live a smarter money life. Hello, everyone. Welcome to another episode of the Smarter Money Life podcast. I'm your host, Andy Mattingly, and today we're going to talk about what it makes to be a good borrower. Now, most lenders look at the same criteria, and if you want to build your borrowing profile to get the loans at the best terms and at the best rate, then you have to be a good borrower. And there are generally 5 characteristics that most lenders review in a person's borrowing profile. Joining me today is Vice President of Underwriting here at Forum, Kurt Niles, who has over 30 years of experience reviewing loans and identifying the key characteristics of what it takes to be a good borrower. Kurt, thanks for joining us today.
Thanks for having me. Glad to be here.
We're going to jump right in and just kind of go through a few questions. So why is a credit score important at all?
Well, a credit score is important for obvious reasons when you're trying to apply for a loan and trying to get the best terms and rates available. But some other things that people may not think about is that could cost you money in the long run. There are homeowners insurance that will pull your credit. There are auto insurance that will pull your credit. If you're not a homeowner, when you go to rent an apartment, they're going to pull your credit. You may or may not need a cosigner based on your credit history. And even in employment situations, sometimes the employer, depending on the type of job you're applying for, could be pulling your credit. Could be the difference of getting an offer or not. But as it pertains to lending, nearly every lender out there uses a FICO score, a credit score, to make their credit decisions. And they're going to use it in a manual underwriting situation, and they certainly use it for automation. So if you're needing something quick, the higher your credit score, the quicker you're going to have access to those funds. They're also going to use that to base the risk model off that FICO score or credit score to give you a better interest rate, which could cost you money in the long run.
So, people think about a credit score. Can you kind of explain how a credit score is sort of derived? Like, what do people do to get to a credit score?
Sure. So there are basically 5 components to a credit score, a FICO credit score. You'll hear people talk about FICO and credit score. There are other scoring models, but FICO is probably the most common. The 5 components that go into that to arrive at a score are your payment history, which makes up about 35% of your score. The amount you owe makes up about 30%. Then you have length of credit history, which is about 15%. And the next 2 would be the new credit and the credit mix. So the different types of credit you have, those are about 10% each. So you want to pay attention closely to the payment history, making payments on time, and reducing the amount of debt that you have, or managing the amount that you owe versus what your credit limits are. Those are the 2 biggest components.
And, sometimes people think, well, if I just pay my loans and credit cards on time, that it's fine. But if I have a medical bill I don't pay, or I don't pay my rent, that doesn't matter.
No, that does matter. So all these things will be attributes on your credit bureau which go into, so even a collection will still count as payment history. It's not a line of credit you applied for, but it is a debt that you owe that you are expected to make payments on time. So those can have a negative impact. Medical, not as much as other. You mentioned late on my rent payment. Those collections will show up there, but medical collections do act a little different.
Sure. So we've talked about credit. Another thing is income. Is a stable source of income important, and what defines stable for a lender?
Yeah, so stable income could mean a lot of things to a lot of different people. And we'll focus more on this question on people who are considered W-2 employees, not self-employed. Could be a whole nother podcast in itself. But what an underwriter will look at for stable income is not necessarily the type of job or employment that you have, but the length of time you've been in that job, and not necessarily even the same job, but the same line of work, the same field of work. Some people, there is maybe a misconception out there, I don't want to jump jobs a lot. That's not entirely true. If an underwriter is reviewing this manually, we're going to want to look at a 2 to 3 year history of employment. And if you're in the same field of work and you're continually improving your financial situation, we're not going to view that negatively. But the other side of that is if you are changing employment pretty often, but you're not improving your financial situation and you're getting into completely different fields of work, that could raise some eyebrows and require a further review of your credit history.
Okay, and I think that's something that people sometimes get misinformation on, saying, "Well, I can't change a job." No. Well, if you're changing a job to improve yourself, that's a good thing.
Certainly.
Now, related to this, and a lot of people don't understand this term. It's disposable income. Yeah. Can you kind of explain what that is and why it's important?
Well, first of all, disposable income is just the amount of money that you have left over after you've made all your monthly obligations. So it's whatever you're making X amount of money a month, you're paying this amount of bills, what's left over. And there's a lot of data out there. Certainly our data on our loan portfolio proves that is actually more of an indicator of how someone will make payments on loans than it is your debt ratio. Debt ratio is well known by a lot of people that they know that lenders will look at that, but we look closely at disposable income.
Yeah, I think that's important. Depending upon what type of loan you're getting, do lenders look at your kind of your financial well-being or like your other assets? Is that important as well?
It's very important, especially if you're a person who has a thin credit file or somebody who doesn't have a long credit history. Your ability to save money. We always talk about things that happen to a person during a course of a month that cost money that you weren't expecting. You need to replace your tires, or this is the month that your license plates are due. Just these random things that come up that happen to everybody. If you have shown a history of being able to save money and absorb those little hits every month, that's very important, especially if you have thin credit.
Yeah, and I think that's important for people to realize that you don't have to make a lot of money to get a loan, but you have to not spend a lot of money. That's right. The most important thing, is to making sure that you don't have a lot of obligations out there. Now, there is something that's coming up a lot, like this buy now, pay later type of thing. How do you think people should make sure they're managing that as it comes in? Because that's going to start being reported on the credit bureau report, and that's going to impact their profile in a lot of ways, correct?
Correct. And going back to those 5 components that make up a credit score, that comes into the mixture, the credit mixture. If you're going to go to that route, it may not be a bad idea to ask them if they report to the credit bureau. If you have options of where you're going to borrow your money and one person reports to the credit bureau and the other person does not, then I would go the route that they do. You would want to be very careful if that is an obligation you can pay on time, because that type of credit would probably have a more negative impact if you did not pay that on time. But those are becoming more and more popular, and the underwriters are paying attention.
Yeah, and that comes back into our disposable income discussion too. So there's a lot of things that you have to think about when you can do that. What are ways that people can improve their borrowing profile, regardless of where they are, whether they're pretty, almost like the best credit you can be and all of that, or they're just starting out? What are some of the things people should be doing so they can keep it going?
Well, beyond the obvious of making sure that you can make those payments on time when you open that line of credit, that's a given. But maintaining a steady source of income. So being aware, if you're in a situation where you're getting ready to make a large purchase, whether that's buying a home or purchasing an auto, those are probably the 2 biggest expenses that people will have over their lifetime. You want to have be aware of your employment situation, especially right before that. You would want to make sure that you are in your same line of work or improving your financial situation. So that would be one. And if you're unable to qualify for credit, whether by reason of a thin credit file, we're going back to be able to show a good history of saving. It's not always just, they have a really deep credit history. It's showing financial responsibility. And one of those things is, if you have no debt or have no credit history, am I saving my money? Am I going to be able to absorb that monthly obligation that comes up we weren't expecting? Those would be the biggest ways, I think, to improve your profile.
And, for someone that's younger, it's fine to have a guarantor or to have a co-borrower that's maybe your parent or something like that, because that does help you build your credit, correct?
It definitely does help you build your credit. And a lot of lenders, and you may ask them this if you apply for credit need and cosigner, will allow over time, not a very long period of time, sometimes just 12 or 18 months, to remove that co-borrower from your loan. It's not always easy to find a cosigner because that is another obligation that that person now has on their credit profile. But if you find a lender out there, and we are one of those, that over a course of 12, 18 months, you show good payment history, we will allow you to remove that person from your credit. So now this becomes your individual account.
Yeah, and I think another important thing to talk about with co-borrowers and co-signers, they have to have a good credit profile because they have to qualify for the loan too. And I think sometimes people get tripped up by that. Mm-hmm. They have someone that's willing to co-sign for them, but they really aren't a good credit risk or a good borrower as well. Are there any moves that people should avoid if they want to be a strong borrower? What are some of the things that you would tell our listeners, like avoid these things if you want to get the best deal possible?
Well, beyond the obvious of make your payments on time, we go back to one of the large components, the 30% of credit utilization. So debt ratio is a big thing, and it's not just the debt ratio, but it's the utilization, especially on your unsecured accounts, your credit cards, your lines of credit. You don't want to have those maxed out. If you're opening up accounts quickly and then maxing those out quickly, that could show a sign of financial struggle because you are applying for credit, running it up, getting more credit. So you want to be aware of that. I don't know what the magic number is exactly. It's funny, you read a lot of things and you'll hear different things, but I always tell people if you have a decent sized credit history or a decent length of time of credit, you want to stay at or below that 50% credit utilization. If you're a young borrower or have a thin credit file, you would want to pay attention to opening too many of those accounts too quickly. You want to build up time because, again, length of credit history is another factor. So don't get caught into the trap of I'm getting all these free gifts that they give you for opening a credit card, or I get a free t-shirt at the Pacers game or something like that. Be aware of how long your credit's been open and do not max it out.
And, one of the things that I also tell people is if they get into where, hey, I'm putting everything on my credit card and I'm paying it off monthly, that's fine because you want to get the rewards and stuff. But that may mean that you might want to either get a higher limit or you might want to get a second card that you're not using because it's not like your utilization on a single card. It's your utilization all over. And if you're paying everything on your card monthly, you could be reported at like 90%, even though you're paying it off because it doesn't show up. It depends upon when that's reported and all of that. So I always tell them, it's like, well, my credit score is getting a ding. And it's like, well, you have to think about it. Sometimes you can get an additional line with like what you said, not a whole bunch of them, but to get to that 50% and say, well, I just have this other card I don't use, or you double the amount that you normally put on your card so that you're always at that 50%. And so I think that sometimes people are like, oh, never thought about that could improve my score. A little bit more credit can sometimes improve your score as long as you're not opening up a bunch at the same time, right?
And you made a good point. So it's actually a good thing to have multiple accounts. So even if you have a second or third credit card that you say, oh, I'm only going to make my rent payment with this and I'm going to pay it off every month to get the rewards, it's good to have multiple accounts because you want to get to a magic number of at least 5 or 6 accounts, especially when you're new to credit. As you get deeper credit history or older, that may become less important because you have a deeper history. But you're right. You're 100% right that you want to diversify your credit.
And the other thing is you have a card and you see another card that you want to use and you're like, oh, well, I'm going to close this card and start another card. Don't do that. Leave it open and just don't use it because at least you have the history out there.
That's exactly right. And take advantage of locking that credit card if you're not going to use it, because if that is an inactive card for you, that doesn't mean there are not fraudsters out there who will find that knowing that you aren't paying attention. So you would want to take advantage of that.
So, one of the things is almost everyone can see what their score is today. If they have a loan somewhere, almost every we do and almost everyone else does. So what would you caution people about that score versus scores that maybe lenders use? Because they're not always exactly the same.
Right. There are multiple models of FICO. Again, we're talking about FICO because that's what we use here. There are many different versions of it. We happen to use an auto-enhanced version because a lot of the lending we do on consumer here are auto loans. But the free version that you get on FICO.com, that's an educational score. It shouldn't be too far off what lenders are using. It would give you a good idea, but I would caution saying that is what score everybody's using. Really, the purpose of getting your free credit report is to make sure that the items that are on there are yours, the balances are right, you're checking that. But I wouldn't go out thinking when you're getting ready to borrow money, this is exactly what everybody's going to see. It should be close.
Like if you're getting a mortgage, it's really not one credit score. So talk a little bit about how it works, especially if someone's getting a mortgage with their significant other. Talk about how that all works.
So in the mortgage, when you're applying for a mortgage, they pull a credit bureau that's called a tri-merge credit bureau. And tri-merge meaning that there are three major credit bureaus out there, Experian, Equifax, and TransUnion. And they will pull a credit bureau on each applicant that shows what is on all three of those credit bureaus. Therefore, it will return 3 scores. Most lenders, mortgage lenders, especially if you're going through Fannie Mae or Freddie Mac or one of the larger GSEs, they will use the low middle score of all the borrowers that are applying for that loan as your qualifying score. So again, that's important to keep up your credit profile because each FICO score will report a little differently. These are dynamic scores, meaning that different people that you owe money to, they will report to the credit bureau at different times during the month.
Yes.
So depending on when you're making your payment to Bank A versus Credit Union B versus what have you, your scores will be slightly different. So they're going to use the lowest middle score.
Yeah, and I think that's really important. The lowest middle score of how many of your borrowers are on it. So if you have 2 borrowers,
6.
You really have 6 scores, and they're going to, each borrower has 3, and it's the middle of whoever's the lowest borrower. And I think a lot of time for younger borrowers, that's sort of where they get tripped up on is, well, I have great credit, and they don't know what their significant other's credit score is. So I think that's really important. And I wanted to make sure we kind of came back to that because your borrowing profile on sometimes isn't just yours. It's whoever is on the going to be on the loan with you, correct?
Yeah, and a great example of going back to your first question is why is a score important? And this would be a reason to go out and check your free score versions before you apply for a mortgage so you know what you need to work on if you have the luxury of having 60, 90, 120 days before you're going to apply. Just to give you an example, the difference between having really strong credit versus marginal credit, if you just take you hate to say this, but a $200,000 mortgage nowadays is not a huge mortgage. But if you're going to borrow that money over 30 years, and let's say you get an interest rate at 6.5% because you have really good credit. I mean, that payment for principal and interest is going to be around $1,260 a month. If you have a credit profile that just causes your rate to increase by 1%, that doesn't sound like a lot, but you're going to increase your payment nearly $140 a month. And worse than that, over that 30 years, you're talking about $50,000 in extra interest you're going to pay. So if you just think in your mind, where could that $140 a month help me? Where would that $50,000 over 30 years help me? It's important to pay attention to your credit score.
Yeah, there's a saying that I heard over 30 years ago, and I use it all the time. A poor score will cost you more.
That is a fact. And so you could do those examples all day, even for auto loans that are a shorter period of time. I mean, the difference in interest rate on between A+ credit and a lower tier credit could be up to $5,000 in interest, and that's just on a 5-year loan. Pay attention to your score.
Yeah. And, one of the things lenders use credit scores to see how you've paid in the past. But the other things that we've talked about, how quickly you're taking on credit, your income, your disposable income, kind of gives an idea of how you're going to pay it in the future. So it's not like that one is more important than the other. It all goes together to kind of build that credit profile. So do you have any final thoughts for our listeners?
Yeah, we're going to kind of repeat ourselves a little bit, but as I go through some of these final thoughts, if your financial well-being and your credit score and the impact your credit score has on your financial well-being, there are lenders that will cater to all types of credit history, from the best of the best to the worst of the worst. You can typically find someone to loan you money. But if your financial goals are longer term, I want to start a family, I want to buy a home, I want to retire someday. We just talked about the example of the mortgage, just 1% difference in a mortgage payment. So apply that for all the loans you're going to get over your lifetime, and what that might mean to you long term. Again, with your retirement savings, with saving for a family, saving to buy a home. It's very important to know what your credit score is to give you good buying power, to get the best rates possible. Because the difference in payments and total interest between the best credit and the worst credit can be very costly over time.
Thank you, Kurt. So Kurt has really given us a lot of great things. I appreciate you being here and on the podcast for our listeners. As you've heard, if you enhance your credit profile, you will be a fit borrower, and that does improve your financial situation. And as Kurt just said, that's your lifetime financial situation. So take to heart some of these things, and you can find all of these resources that Kurt's talked about all over our website. But indeed, improving your credit profile is the best thing to do.
That's all for this episode of the Smarter Money Life podcast. Thank you for joining me. I hope you found our discussion helpful and inspiring. You can find more resources on the Smarter Money Life page at forumcu.com. Remember, making smart financial decisions is a journey, and every step you take brings you closer to your financial dream. Be sure to tune in next time for more tips and insights on managing your money. Until then, stay smart and financially savvy.